What are zones, supports, and resistances? What do stocks do in zones? Stocks either bounce off a zone or break it and head to the next one. There are a few types of zones that we'll get to quickly. First, you mark a zone where the stock closed the day before. Some call this fill in the gap. The usual trend of a stock can be to fill this gap. If the stock starts going up, you can mark the zone in the gap and wait for it there to sell your contract. If the gap is below than where the stock opened, then if the stock starts going down, you can mark the zone where the gap is with the same idea. For example, SPY here opened at around 444.63, and it closed the day before at 442. Now, as you can see, it starts going down. Now, your first instinct should always be to let the contract go to 442. For example, it's 444.7. Let's just say 445. Your first instinct should be to let it drop to 442. Why? Because it's filling the gap. It's going to where it closed the day before. It's a high probability it will reach there. The other way is for it to do the reverse. It could open low at 433, as you can see, and then it could reach where it closed the day before. It went from 433 to 436. This is one of the simplest ways to day trade as a beginner. The next way is the most common zones are height of the pre-market and low of the pre-market. Same idea. You mark the pre-market zone, for example. Its highest, you mark it. If it went up, you'd expect it to go up to there. If it went down, you'd expect it to go to the low of the pre-market. For example, the low of the pre-market is not 442.96. It is actually 438. Now, there are two zones. The close of the market of the day before is 442.96. In the zone, you either bounce off of it or you break it. Here, of course, it broke. So what you should do, you wait for it to reach the low of the pre-market. That's the next zone. This is a perfect way to make a lot of money. For example, 444, 438. It's easily $6. You're talking about a 1,000% upwards, depending on what type of contract you bought. Now, since this is a day trading in 5 minutes or less, we will talk more complexities in a later video. Now, you may skip this part if you know how to day trade, but what are contracts? There are two types of contracts. Calls and puts. Call meaning you are putting money that the stock will go up and gain profit when the stock does move upwards and lose money if the stock goes down. Put meaning you are putting money on that stock will go down and lose money if the stock goes up, but gain money if the stock moves down. Simply, you buy a call when you analyze that a stock will go up and buy a put when you analyze the stock will go down. It uses stock zones to guide you, as I've shown you here. Also, always try to buy contracts in the money, at the money, or very near to the money, being close to the strike price. Strike price being the price you think the stock will go. The closer the strike price is to the actual stock price in the moment, the more money you'll gain when the stock moves, how you analyzed it to move and were right, but also risking more if you are wrong. And you always buy your contracts below where it says ask. It is highly recommended you buy your day trading contracts for the same week, or if it is an index like SPY, then for the same day, if it is early when you're buying it, for maximum gains. And the blue is in the money, which means the contracts are more expensive. The left side is where you buy calls, and the right side is where you buy puts. And this is learning how to day trade in 5 minutes or less. Thank you.